Equity method accounting exists when a company has an investment in another business that it has influence over but not full control. The investee can also be called the associate or affiliate. And this occurs when the company has a 20 to 50% investment in the business, meaning it controls 20 to 50% of the voting rights. So let's look at how it actually works. We'll explain the concept of an equity pickup. The first step is an investor reports the investment that they made in the associate at the cost. Then, all of the profits and loss from the associate increase or decrease that investment by the proportionate share ownership. And then finally, any dividends paid out from the associate are a reduction in the investment account. Let's see how this actually works with an example. Imagine that Lion purchases 30% of Zombie Corp for $500,000. At the end of the year, Zombie reports net income of $100,000, and half of that, $50,000, is paid out as a dividend to its shareholders. Here are the transactions that would take place. When Lion initially makes the purchase, it's going to record a long-term or non-current asset called investments in associates. So it would debit $500,000 to investments and associates and credit cash for $500,000 to pay for it. Let's look at the next transaction. Lion receives its dividend of $15,000, which is its proportionate share, and records that transaction. So it debits cash $15,000 and credits the investment in associates $15,000. And the third step is that it records the net income from Zombie as its proportionate share into the investment account. So it debits investment in associates $30,000 and credits investment revenue $30,000. Let's see how it all fits together. Here's our T-table. Investment in associates initially $500,000 is the original investment, less a $15,000 dividend, plus $30,000 of net income. So the closing balance is $515,000 at the end of the period. Here's the whole Zombie company. The whole company had net income of $100,000, $50,000 of dividends, and so therefore it had retained earnings of $50,000. Each of those items get multiplied by 30%, as that's Lion's proportionate share. Hopefully this has illustrated how to perform the equity method of accounting.